U.S. indices start to rally early on Thursday. Before we start, a quick word from our sponsor. This video is brought to you by FXEmpire, the world's leading retail brokerage firm offering ultra-fast execution and no overnight fees. Look for a link in the description below. The NASDAQ 100 has rallied a bit during the early hours on Thursday as we continue to see buyers on dips, and I think at this point we are probably going to have a situation where traders are looking at this through the prism of trying to find value. After all, the Federal Reserve has started to cut rates, and of course Wall Street loves that. Tesla had great earnings overnight, so that of course comes into the picture as well. And don't forget, we have plenty of other companies out there with earnings reports. Nonetheless, the momentum is to the upside longer term, and we did have a nice recovery late in the day during the previous session, so one would have to assume that we are going to start heading higher again. The Dow Jones 30 has been very quiet in the early hours, but it is stabilizing. That, of course, is a major victory when you have spent 3 days selling off the market. All things being equal, this is a market that I think shows that we do have a certain amount of buy on the dip mentality, especially as the 41,900 level underneath is a massive support level, with the 50-day EMA coming to the rescue as well. Either way, I think the Dow Jones 30 is much like the NASDAQ 100 in the sense that it is a buy on the dip scenario. In the S&P 500, we have had a fairly strong move in the early hours, and it looks like we could go looking to the 5,880 level, which is where we peaked previously. And I do think eventually the S&P 500 does go looking to the 6,000 level. That being said, it is worth noting that all three of these indices could be affected by the flash manufacturing PMI numbers later in the day, as well as the flash services PMI numbers coming out of America. Nonetheless, I think if we do get some type of knee-jerk reaction, the market continues to grind higher. It's also worth noting that part of what's been going on is that the interest rates coming out of the bond market in the 10-year specifically have been spiking, and that of course has people stepping away from stocks and heading into the bond market, and that's part of the volatility that we've seen. However, when you look at the longer term charts, the volatility really is nothing but a blip on the radar. If you enjoyed the video, give me a thumbs up and subscribe.